have welcomed the opportunity to work together with FINRA in public-private partnerships. We're contributing our know-how. We're welcoming deploying artificial intelligence together to surveil the markets. So automated trading firms are incentivized to detect bad actors because we too can be the victims of fraud. And as bad actors become more sophisticated globally, it's absolutely vital that financial regulators have the funding resources so they too have the technological capacity and access to AI and automated technologies to be a strong and effective cop on the beat. Third, as AI technology matures, we can expect increased demand for high-quality, robust data, including alternative data, to provide what I call the crude oil for the engines of AI. This entails large quantities of complex data that humans alone cannot digest. So I think we're going to see policy questions arise around this proliferation of data. I think it was already noted questions of competition and antitrust in the digital marketplace. We're going to see increasing discussion of intellectual property rights and ownership rights of that data, and questions of access to that data and the cost of data. I think alternative data has been successful in helping establish a credit history for the underbanked. That's one positive. But I think we need to continue discussion surrounding algorithmic bias. And in my prepared testimony, I've noted next steps, including industry-led initiatives to share best practices, utilize ethics officers, and RegTech approaches. And last, I want to talk about future of workforce. AI and automation can and should be a tool rather than a replacement for humans. Some jobs will disappear and others will grow. Areas of growth we can expect to see are in the computer occupations, jobs related to the transmission, storage, security, privacy, and integrity of data, the fiber optics industry. They're all going to be fueling the AI economy. There's massive demand existing for qualified technological talent across virtually all sectors of our economy, particularly in the financial sector. The current baseline participation for women, and particularly of women of color, is something that leaves room for substantial improvement, and that's something we're focused on. And a skilled workforce for tomorrow's Wall Street is only as good as the companies there to invest in technology. I thank you for your time and yield the time for the next witness. Thanks.
Thank you. And Ms. Ratio, you're now recognized for 5 minutes to give an oral presentation of your testimony.
So my microphone is not working.
Is it the button? The button?
The button doesn't work.
Oh, the button is not. Yeah, the microphone's very directional. If you rotate it straight at you, it helps.
Thank you, Chairman Foster and Ranking Member Laudemick, for the opportunity to testify on the impact on AI on our capital markets. Many people associate AI with high-tech and movies such as The Matrix and The Terminator. But we at NASDAQ strongly believe that we can use this technology to target a wholly different prey, the fraudster. As you know, NASDAQ has extensive experience leveraging technology to operate our markets and markets around the world to protect participants and investors. We operate 25 exchanges and 6 clearinghouses around the globe, and we sell marketplace technology, trading, clearing, and surveillance system to hundreds of the world's markets, regulators, exchanges, clearinghouses, and broker-dealers. Our internal surveillance department is monitoring for the markets for insider trading, fraud, and manipulation, as well as handling real-time events in the market. The accessibility of the markets and the increase in players with the ability to deploy manipulative strategies using their own technology and the exponential increase in data quantities can act as a perfect ecosystem for market manipulators to hide amongst the noise. This increased complexity in monitoring presents new challenges for the surveillance team, relying on preconceived parameters and known factors to detect manipulative patterns. Our surveillance program is using algorithmic coding to detect unusual market behavior, running over 40 different algorithms in real time, utilizing over 35,000 parameters. In addition to real-time surveillance, there are over 150 patterns covering post-trade surveillance to identify a wider range of potential misconduct. The team proactively develops tools and procedures to increase the quality of surveillance and to meet changing demands in the market. But with the manner in which patterns are currently recognized, relying on known factors to describe behavior, it can be difficult to capture new behavior and to remain proactive rather than reactive to threats in the market. In addition, predefined expectations of what patterns look like can often limit alert results depending on how alert parameters are calibrated. Calibration also presents a continued challenge when determining the best balance between false positive and true alerts. These challenges led to a collaboration between the NASDAQ Machine Intelligence Lab, NASDAQ Market Technology Business, and the NASDAQ US Surveillance Team to enhance surveillance capabilities with the help of artificial intelligence. Using AI to detect abnormal behavior pattern is based on the notion that manipulative behavior can be identified by signals in the market. That a scheme to defraud market participants often has a specific pattern to it. It is a price rise or decline, an action is taken, and the trading is then back to norm. So this signaling concept leads to new ways to look at pattern detection. By leveraging AI, detection models are not tied to static logic or parameters. We are able to train the AI machine based on visual patterns of manipulation, and we started to look at the spoofing pattern. The machine was then further trained with human input, and then transfer learning was used to expand the scope of the project beyond spoofing. Transfer learning leveraged AI to apply a model developed for a specific task as the starting point for a model on a second task. By using deep learning and human-in-the-loop techniques, the new models for detecting market abuse with our initial spoofing examples indicated usable results with 95% fewer examples than typically required. The inclusion of AI into detection function will allow us to focus the effort on in-depth investigations on potential manipulative behavior instead of triaging a high number of false positives. But to be clear, the human input is still of critical importance, both in analyzing the output from the surveillance system, but also in continuously training the machine to produce more and more accurate outputs. The massive growth in market data is a significant challenge for surveillance professionals. Billions of messages pass through a larger market on an active day. In addition, market abuse attempts have become more sophisticated, putting more pressure on surveillance team to find the needle in the data haystack. By incorporating AI, we are sharpening our detection capabilities and broadening our view of market activity to safeguard the integrity of our financial markets. Surveillance is a critical use case for AI, but NASDAQ is also looking to apply it in other business. For example, we're using a version of AI, natural language processing, in the listings business to facilitate the compliance review of public company filings. In closing, we are convinced that this use case for AI will benefit investors and the resiliency of the US market and the other markets that we serve. Thank you for the opportunity to testify, and I'm happy to answer your questions.
Thank you. And I will now recognize myself for 5 minutes for questions. I should also mention to the members present, it looks like the latest estimate for votes are now 11:30. So we may, in fact, have time for a second round of questions for members that are interested. We'll have to play that by ear. Dr. Lopez-Soprado, you noted in your testimony that today data vendors offer a wide range of data sets. I think other members, other witnesses mentioned that, things that were not available a couple years ago. And not only the data itself, but the processing power to analyze it and the real-time delivery of that data is becoming more and more important to successfully trade on it. Could you just illuminate for us some of the more interesting data sets that you now see being used?
Certainly. It's a combination of data sets. On one hand, we have access now to credit card transactions, geolocation data, satellite images, transcriptions from earning calls, engineering data, data from engineering processes like exploration and production companies that allow us to estimate better what is the yield of various wells for extraction of oil or fracking, all sorts of data. Keep in mind, please, that 80% of all data recorded today was generated over the past 3 or 4 years, going back to history, going back to Mesopotamia. There is a lot of data around, data that we aren't even aware of, but it's just being scraped from website, chats. So all of this data can be used to understand what is the psychology of people, what is the state of mind of people, understand if people are more proclive today to take risks or to, for instance, relocate their assets to fixed income instead of stocks. Try to understand from news articles, as one of my colleagues mentioned, what are the narratives associated with particular companies. So the amount of data today is staggering, and this is only going to increase because The storage of data is becoming cheaper every day, and the processing power is increasing. So this is definitely a trend that is not going to stop.
Yeah, and now that, as I think I mentioned in my opening remarks, that has a danger of driving monopoly. That, the returns to scale, because you get more correlations to look at with your AI if you have the full range of data. And so this will naturally cause the smaller players in the market to, not be as effective, less profitable, and ultimately, and I think, that's part of probably what you're seeing in high-frequency trading, the consolidation that you're seeing there. Now, is there any way around this? And how hard should we lean against the natural tendency to monopoly here in financial trading?
Yeah. So there are two schools of thought with this regards. Number one, there are a number of academics who believe that this consolidation is not necessarily negative, in the sense that the few survivors that are able to consolidate, for instance, high-frequency trading, today are operating like utilities. They are not making the kind of returns that they were able to obtain 9 years or 10 years ago. Essentially, what happens is that they break even. These technologies are becoming so expensive that they have to spend this time and money in order to achieve a profit that is dwindling. So there is a number of academics who believe that actually consolidation is not necessarily negative. There is, on the other hand, of course, the problem that a small number of operators could have a grip on the market, and it's also could cause a domino effect if one of them fails to provide liquidity. So there is a need to strike a balance between, on one hand, preventing too much consolidation, and on the other hand, also favoring competition between these operators.
Yeah, Ms. Wegner, you mentioned that this actually netted out, or at least electronic trading generally netted out very positively for someone's retirement account, that it actually, because of the lower bid offer spreads and transaction costs, that actually was, I think you quoted 30% more in your retirement account as a result of this. So similarly, when AI is widely deployed, if it's very effectively deployed, in principle, we get a more efficient capital allocation across our country. And so is actually the best strategy to let a small number of very dominant players have access to all the data set to get a more efficient economy, and
I think it's absolutely,
or are we better off just letting 1,000
I think it's
flowers
absolutely vital that we encourage policies that promote strong competition in this space. And with high-frequency trading and automated trading, we've seen such fierce competition over the past decade or two that we're approaching near zero latency speed. We're approaching the speed of limits of
but also more monopolization. Well, I think my time is out here, but this is something I intend to return to if we get a chance here.
I'm happy to respond.
Thank you all. Oh, I'd also like to remind all the witnesses to speak as directly into the microphones and as close and as loudly as is comfortable for you. Right. Now you have 5 minutes to the ranking member.
Thank you, Mr. Chairman. Ms. Wegner, as you know, the SEC has experienced some cybersecurity difficulties, especially in the 2016 Edgar data breach. I think it's important for the SEC to only obtain proprietary trading algorithms if absolutely necessary with a subpoena. So I was wondering if you could discuss why it's important for source code to be protected.
Sure, that's a very good question. So the real lifeblood of automated trading and the kind of secret sauce is the source code. That is the valuable intellectual property that the different firms are competing against each other with, not just domestically, but globally. And just like a self-driving car company needs to keep its algos and source code and intellectual property protected from misappropriation, so do algorithmic traders rely on government protection of their intellectual property. There was a proposal a number of years ago to perhaps collect IP source code and put that in a government repository just in case it was needed. That never came to light, but it's still something we're absolutely educating policymakers on. This should be, I think, a bipartisan area of interest to ensure that we have a globally competitive marketplace that protects intellectual property rights of source code.
I appreciate that. From my time in the military working in intelligence, we had a principle we live by because of the sensitivity of the data that we collected and maintained was if you don't need something, don't keep it, which means if you don't have to protect what you don't have. And my concern is how vulnerable the industry becomes because, quite frankly, the government tends to be the weakest link when it comes to data security in some aspects. So I think obtaining that source code is not only just a violation of the privacy right of the business, the coder, but could also be a national security risk. Is that?
I mean, I think that's right. If bad actors were able to breach the source code, it would be presenting an opportunity for manipulating the markets or cyber risk. So it's absolutely vital that we protect the intellectual property rights of source code.
Thank you. Ms. Fender, the adoption of artificial intelligence and electronic trading can disrupt the job market and displace for traders, but technologies also create a need for more workers in other fields. Today we have about 1 million people working in the airline industry, but in the early 1900s, the Washington Post led a headline that said, "Man will never fly and shouldn't." And part of their argument was the displacement of people in the job market. Could you touch on the job fields that are growing because of the use of AI in the capital market space?
Yes, thank you. As you noted, there are many ways that jobs are changing. Adaptation is really the key. So when we surveyed industry leaders, the people that are doing the hiring, and we said, what are the most important skills going forward? Maybe it's not necessarily the job description. What are the skills underlying who will succeed in the future? And they talked about something called T-shaped skills, right? And so this is the idea that if you think about the letter T, you've got the vertical bar where there's deep subject matter expertise, and a horizontal bar where you can cut across different disciplines, right? And if you think about fintech, if we have a big risk if there's fin over here and tech over here and they aren't talking. And so the ability to connect the two is where there's a lot of opportunity. And so these are the innovators. This is an area where you'll see more research needing to be done so that we understand what the trends are. And the key thing is that people have to ask the right questions. Firms are realizing you have to think about the ROI of gathering this data. And many of the machine learning people will say a large percentage of the data isn't that useful. So you have to be smart about how to do that and start the process with investment professionals.
Okay. And so getting at is not all the jobs are going to be just this deep intellectual, being able to code and understand algorithms and that, but there are ancillary jobs that come about because of the development. Is that a fair statement?
Yeah, definitely. We don't think, for example, that all CFA charter holders need to become programmers, but we think they're going to have data scientists on their teams, and they're going to need to speak the language and work together.
Okay. Ms. Ratio, I want to talk about the use of artificial intelligence in fraud detection. I view cybersecurity as the biggest challenge that we face in this nation, both from a business, government, and personal perspective. Can you touch, real quickly, running out of time, how algorithms are used to detect unusual market behavior?
Yes, so as I said, we really rely on algorithmic coding to pick up on the unusual patterns that we see. I mean, everything needs to be compared to something that is usual, right? So we program things to pick up on the unusual things based on historical comparison on specific stocks, how they have been trading in the past. So that's what we do already, and we have done for a long time. The new thing here is...
At this point, I think we'll leave that to your, and hopefully to your next round of questioning. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you very much to the chair for putting this together. We appreciate it. And also those of you who've come testify, thank you very much for your comments and for your work. Automation technologies, which enable the transfer of tasks from human labor to machines, affect approximately 6.4 million workers employed in the financial services industry. Specific industries like credit lending and capital markets are being affected by AI as human tasks involving data analysis, decision-making, and compliance are replaced by machine learning robots. The shift in job automation could predict which jobs in financial services will be replaced and what new jobs could be created. Ms. Wagner, specifically examining loan underwriting compared to the traditional methods of meeting a loan application in person, to what extent does AI replace or augment the work done by loan officers, credit counselors, or other credit underwriters?
Sure, that's a very good question. So in the consumer lending context, I think it's very important that AI is a tool for humans when they're extending credit and extending loans, that there are systems in place to ensure that there isn't any sort of algorithmic bias. And in my prepared testimony, I noted some suggestions. Our members are not engaged in the consumer lending context, but we have our own insight. I think that loan companies, individually or collectively, could employ ethics officers to ensure that there isn't algorithmic bias in the lending context. I think it's important that industry members share lessons learned as they explore how they're democratizing access to credit and finding the most efficient ways to extend that credit. I think it's really vital that we act now to make sure as we're building out those systems that we minimize the risk for algorithmic bias in consumer lending. I think it's very vital.
Thank you, ma'am. Is the U.S. properly equipped to remain competitive in the financial services workforce? This question is to Dr. Lopez de Prado and to Ms. Fender.
The U.S. is the leader in the financial services industry today. My concern is that this leadership is being challenged by the fact that, on one hand, we are not investing as much in AI as other countries. And number two, the fact that we are educating our competitors. In my remarks, I mentioned that I'm very concerned that the innovators of the future are attending today a class in our universities, but they will not be allowed to stay. And as a result, yes, we are very competitive, and this competition, this ability to train these skills is going to turn against us if we are not able to retain this talent.
Okay, Ms. Fender.
We have seen that, again, it's early days for how this changes our industry, with only about 10% actually using these techniques. But what we are seeing is that, firms are doing AI labs, they're doing innovation hubs. They realize that this is something they need to be proactive about. And so we are seeing that out of our case studies, we had a criteria that things in our case studies had to actually be in practice. There's a lot of talk out there, but things that are actually in practice, 5 of the 9 are here in the U.S.
Great, thank you. Dr. McElwain, are we adequately teaching the skills needed for the jobs of the future?
Thank you for the question. I think we're adequately teaching those skills. I think the question is about who has access to that teaching. And so when we think about underrepresentation of certain individuals and members of the workforce who are not getting the types of education that are needed for the jobs that may be coming online as a result of automation and AI development. And so I think if we're to have a full pipeline of folks that are able to receive what it is that we teach in our colleges, universities, even high schools and younger, then we have to be more proactive about making sure that all people have access to that teaching and that information.
No one left behind.
Absolutely.
All right, I appreciate it. I'm going to yield back, Mr. Chair. Thank you very much.
Thank you. And the gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Well, I appreciate each of you being here today and appreciate the chairman for holding this hearing. This is an important topic, something I've been really passionate about since arriving here in Congress. And Dr. Lopez de Prado, I appreciate your comments because what you have touched on is something that I have been an ardent believer in for a long time. And that is, number one, that the big arm of the federal government isn't going to stop the growth of this technology, isn't going to cease the investment in AI, either here or around the world. And while we can shape the context by which that technology flows, we are not going to dam up and stop that technology. And so when people say job losses may result on account of this, right, there's a lot of fear and a lot of desire to put an end to that. and to stop that. But I like how you referenced a lot of training and retraining that may need to happen. Training individuals that are graduating from school to ensure they have the skills that are necessary in a 21st century workplace, but also ensuring that those that are already in the workplace have the opportunity to get the retraining to continue their competitiveness. And as we see further growth and development in AI, it will require more and more frequent retraining to stay ahead of that, to stay relevant in that field. That is a very competitive field, right? But the second thing you touched on is something I'm even more ardent about, a lot of ardor expressed, but is we educate a lot of kids in this country. We do higher education in this country better than anywhere else in the world. We bring a lot of talent into this country. We invest a lot in those kids, and then we politely ask them to leave at the end of their tenure here, right? That is embarrassing, that is idiotic, that is stupid, and I hate that. I want to find a way to attract talent in this country and retain talent into this country. Not because I believe it's a zero-sum game, but because I believe that this country can provide a crucible for technological development that you can't find elsewhere in the world. And I think that technology will benefit humankind overall, the world, in the long run, and I want to make sure we do that. So I really appreciate you touching on those topics, and I really appreciate that investment. Of time. Ms. Wegner, I know that you have a source code event today, yesterday, tomorrow?
This afternoon.
This afternoon, right? To talk about source code again, and I really appreciate you continuing to educate a lot of people about how important that is. Where I go, all the way across the district in Indiana, I hear more and more about how much technology, how much investment, how much IP is in things that aren't readily seen, right? Either in business processes, in the source code, in the technology, underpinning automation itself. And so I know how important that is, and I really appreciate you bringing that to light. All that being said, I wanted to ask Ms. Ratio a question. That is maybe a little bit far afield from what we're talking about today. I had some people in my office earlier this week that were very complimentary, frankly, of NASDAQ surveillance services. We were very complimentary of, they were public companies, and how when something seems amiss in the markets, that NASDAQ was very quick to pick up the phone and say, something seems amiss, let's figure out what's going on here. One of the things that is very important back home is biotech, right? A lot of biotech firms are based in Indiana. People don't know that. We're trying to get the word out about it. And they're concerned about market manipulation, specifically with regard to short selling. And they are promoting this idea that there should be more disclosure around short selling, similar to many long positions. Now, they came in and said that disclosure around short selling would really help us as a firm better understand those that might have interests adverse to us, because we can't really track that right now. But the counter argument that they made was, gosh, NASDAQ seems to be doing a really good job of figuring out when there's potential manipulation. I wondered if you might touch on that. Is disclosure...
Surveillance, right?
Yeah.
It's information is always needed to understand what is happening.
Okay.
I do think that what we have today is sufficient. I mean, as you say, we have a lot of patterns that are detecting manipulation, such as short selling.
Great.
Or I might say the troublesome part of short selling. I mean, short
Right.
selling is legal, right?
Right, of course.
So it's really to detect what is then being, how it's used in an unnormal way or in a sort of manipulative.
So you
kind
feel
of
like
way.
you can detect the activity that would be illegal or abnormal or different adequately. The question is, what do we do with it after that point is maybe where we should focus public policy attention. Is that fair?
Yes, but to be fair also, there are other parts within NASDAQ that handles more of the policy questions.
Okay.
But for me as a surveillance practitioner, I do think that the disclosure we have and the tools we have to monitor the markets
Are adequate. Great. Well, I think that's an important question, because when they were in my office, I think that's the question. Where do we need to focus public policy attention? And perhaps it's beyond surveillance and focus more on some of the penalties or some of the actions that happen with the enforcement agencies. With that, I'll yield back.
Thank you, and I'm very encouraged that one of the areas of bipartisan agreement here is the insanity of this business of awarding people their PhD diplomas and pushing them back on an airplane. And so that's one of the reasons I was proud to introduce this session of Congress, H.R. 4623, the Keep STEM Talent Act of 2019, designed to, as a rifle shot, to just exactly solve this problem. And I really look forward to my colleagues' support on this. And now I'd like to recognize the gentlewoman from Texas, Ms. Garcia, for 5 minutes.
Thank you, Mr. Chairman, and thank you again for holding this hearing, and thank you to all the witnesses. Good morning and welcome, and wanted to focus on a couple of issues that some of you have already talked about. And, like Ms. Adams, I'm particularly concerned about jobs. My district is from Houston, and 77% Latino, and it's also working class. So we're always concerned about jobs. And I'm encouraged that you all seem to have the consensus that although there'll be some job displacement, that there will be new jobs created. And my main concern, of course, is whether or not we do have the skill sets, Mr. Macklin, to transfer those skills or to make sure that we can fill those jobs. Because in the end, that's what really matters to families in my district. But I'm also concerned with automation and the difference between, AI and automation and how it can work together, specifically in the area of regulatory compliance. So Ms. Fender, in your experience, has AI and automation affected institutions' regulatory compliance? Is it improving? Is it still work in progress, or how are we doing?
Thank you. That's a very good question. And again, I think it's still kind of early to know, right? We hear so much about what is coming, and yet, so compliance areas are growing in firms, right? Clearly. And now we have more and more data, and regulators are going to be able to have the same sort of data, right? Now, the question is there a greater risk maybe of insider information now, right? You collect more data, and people can see lots of different patterns out there, and if they see that and can trade on it before the market, then you have challenges for the SEC, I think, in terms of Reg FD and so forth.
Okay. And Ms. Wagner, can AI be used to simplify and ensure regulatory compliance with the federal agencies in charge of supervising the capital markets?
Sure. I mean, I think as the data sets become more complex, as you just alluded to, I think it's going to be vital that the regulators have the resources to have their own AI, either independently of the companies or together with the companies through public-private partnerships. As the bad actors become more sophisticated, and we're talking about global bad actors, we need a strong cop on the beat here in the US. And I think it's very important that the private sector work together with regulators to ensure that they have those resources, and that Congress really explores if the SEC and CFTC have the resources they need, because the systems are becoming much more complex, and reg tech is evolving, but needs to keep up with the pace of that technology.
Well, I think that is a big concern of this committee, is those bad actors, as you've described them. So how can AI assist us with money laundering compliance and suspicious activity reporting? I mean, are we well prepared for that? I mean, I know we did a CODEL to several countries, and things are getting more and more sophisticated, and it seems like the bad actors have more money and better things, to find ways to hide the money. Do we have what we need to detect it and ensure that we can catch it?
It's vital that we focus on this, and I would say Hymera Workey, who's the new head of innovation at FINRA, has an excellent group. They just established themselves this year. They're a fantastic resource. They're working together with other regulators, with private sector participants to gather information about best practices and to really make sure we have the best technology. This is 100% something we need to be focused on.
So in your opinion, do you think that in our oversight entities are well prepared in this arena, or what else should we be doing?
I think we need to be investing in technology. There's always room for more technology with the regulatory agencies. I think MIDAS at the SEC has been a very positive example of the SEC using very sophisticated technology to surveil the markets. But I think this is a constantly evolving space, as everyone here has noted. We got to just keep very much on our tiptoes on this and keep on investing in this area.
All right. And Ms. Fender, did you want to add something?
I think the more data we have, the more complex it gets, right? And one of the other things that we're really concerned about is the investor protection side too, right? And if bad data goes into these models, they can be marketed in many different ways, and so disclosure is really important. So understanding your clients, understanding where the money comes from, and understanding what clients are really getting, it all kind of goes together.
All right. Thank you. Thank you both of you, and I yield back.
Thank you. Gentleman from Virginia, Mr. Riggleman, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank all the witnesses for being here today. I'm so happy that all of you are here, so I'm not showing any favoritism. And I would particularly like to welcome Ms. Fender from the CFA Institute, which is located in my district in Charlottesville, Virginia. The CFA Institute provides a host of resources for professionals who work in the financial services industry, who are among the most qualified and adhere to the highest codes of standards in the financial industry. I am honored to have such a distinguished group reside in the 5th District, and although Mrs. Fender is not a constituent herself, her organization employs many of them, so I'm thrilled to see you here today. Welcome, and welcome to all of you. And so I'll start with you, Ms. Fender. You probably knew that was going to happen. But can you talk about how CFA is adapting the charter to these AI and machine learning innovations in the investment industry?
Yeah. Thank you very much, and pleased to be here representing Virginia. The CFA Institute is really the global standard for investment practitioners, right? The people that have our credential are the portfolio managers for your 401k. They're the chief investment officer at the public pension fund. They're people that are really safeguarding the financial futures of so many people. And so it's imperative for us to keep up to date on what we teach. So I mentioned earlier in my testimony that we've just added machine learning into our curriculum, and this is a significant indication that we are seeing the market change, and we need to prepare people. And so we have a group called our practice analysis team, and they are out there all the time, going to these conferences, figuring out what's the next thing that people need to know. Because global demand for investment management is growing, and especially for those who really combine both competence and ethics.
Yeah, and really is a reason I asked the question. So my prior job, and we talked about monopolization of data, things of that nature, was I wanted to monopolize as much data as I could for data interactions when looking at critical infrastructure analysis when I worked for the Office of Secretary of Defense. So we had about 40 people looking at this. So we had to look at all data, multi-domain, across stovepipes, right, and see how to actually kludge that data, or to analyze or aggregate that data, consolidate it, aggregate it, analyze it, and execute using that data based on how we templated human behavior. So looking at AI and ML rules, I guess, and I'll start with Ms. Ratio, and I'm going to ask a few of these because this is the exciting part for me, is the technology part. I mean, do you see, when we did this, we had multiple data sets that people had never seen before. We talked about the challenges of data. We had multiple data sets, and we had data we had never sort of aggregated and combined with other data sets, so we thought we had the right answer, and we found out we didn't, and trying to template human behavior analysis. Do you think that's something you're going to see more of in the future, is that there won't be a human in the loop, and there'll be more sort of human templating or machine learning rules to sort of mimic what human behavior does with certain rule sets? Do you think we're going to see more and more of that, taking humans out of the loop, looking at actually any type of analysis or fraud or anything of that nature?
So I think that we are a long way from that, at least. I think that for now, the way that we do it is really to have the data that we have. For us, it's really much, it's the order and trade data, right, that we already have and that we analyze. So now we're just applying a new technique to give us more, a better overview that is not that parameter driven. But for us still, I really think that the human in the loop is the way to go, because there is much more analysis that needs to be applied after the output has come. And I think that's going to be there for a while.
It's interesting you said that. When we saw the human we actually thought we could take the human out of the loop in some of our processes and found out it was not a good idea, right, with some of the things that we did. I see some head nods back there. So we try to do that. So, and Dr. Lopez de Prado, you were talking about there could be some advantages to, sort of aggregating as much data in one place as we can, right, and then looking in the gaps of that data. That's the thing I've been trying to wrap my arms around. My whole job was not competition. It was to monopolize all the data, right? And then to use competition to give us the best algorithmic solutions that we could for first, second, and third order effects of what happened to a specific part of the network. This is a tough question because to be this subjective in 40 seconds is going to be probably ridiculous. But when you're looking at this, do you think, and I know this is a tough question, do you think that with all the proprietary technologies out there, do you think there will be a voluntary sharing of that data if we find something that's very good, right, across multiple sets? So, for example, another company, do you think we will have that type of sharing for proprietary solutions based on algorithmic types of analysis? Do you think that would ever happen, or do we think we have to sort of force that to happen when we monopolize that kind of data?
So
If that makes sense, I hope I asked that
are
question.
you referring to sharing these technologies between
Yes.
private and public companies?
Yes.
Well, when you look at the NASA model, actually, there has been a lot of transfer of IP between the agency and various contractors. So that could be a model that could work for the CFTC and the SEC. In particular, in my remarks, I mentioned the crowdsourcing of investigations, how several companies or private participants could establish tournaments to help agencies identify market manipulators.
Thank you very much, and I yield back the balance of my time.
Thank you. The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you all so much for coming. Back in my prior life, I had a head of engineering who had a theory that I've yet to prove wrong, that he said every advance in technology gives us more precision and less knowledge. This was a guy who started with slide rules where he had to know the order of magnitude of his answer, and now he got 16 significant digits and can never remember whether it was millions or billions. And of course, in my lifetime, we've gone from foldable maps to GPS that can give me the exact latitude and longitude, and I can't tell you whether I'm north, south, east, or west of where I started. AI has always struck me as sort of putting that acceleration on steroids. And at one point, I built a genetic algorithm to predict the revenues of our utility business, and it was amazing. I cut our revenue forecast variance by 90%, and I have no idea how it worked. And that's the power and the frustration. And I mention that because I think most of you have talked about the consumer benefit that comes when we get all these AI algorithms out in the markets and we get lower trading costs, lower bid-ask spreads. And that's all terrific. The question I have, and a lot of you have also talked about bad actors, and we can put up monitoring for that, and that's also great. The concern I have is this tension between the transparency of the model and whether the model can actually effectively replicate a bad actor that we don't understand. Because it's fairly easy for me to imagine a trading algorithm that is tracking a bunch of data and has figured out how to bet on one country invading another and making money. I can imagine a trading algorithm that's looking at changes in currency flows for illegal activity that's not in itself illegal, but is arbitraging some spread that results from that. So, Ms. Wegner, I wonder if you'd comment on that tension between transparency and algorithm robustness, and to what degree we have or need regulatory tools to stipulate where we sit on that continuum.
Sure. I mean, I think transparency is absolutely vital. I think it's also very vital that regulators and the exchanges have the resources that if they note any sort of irregularity in the markets, that they can immediately identify that. And to the question of whether or not one needs to get source code, if there is a detection of some sort of illegal or irregular activity, that then the regulator requests.
But if I could just clarify, first, would you agree that the more transparent the algorithm, potentially the less powerful the algorithm?
I mean, I think to the extent that the algorithm is not subject to intellectual property rights, that transparency is absolutely vital. If we're talking about intellectual property rights in the source code of the algorithm, that's proprietary information that if it was
So by transparency, though, I'm not referring to whether or not the public has access to the algorithm. I'm referring to whether or not our human brains can understand how the algorithm works.
Got it.
I could give you the genetic algorithm I
Sure.
wrote. You couldn't understand what it's doing.
Sure. I mean, that question becomes more complicated in machine learning context.
Where the signal-to-noise ratio is very low. Unlike, for instance, in astrophysics research, what happens, why is the signal-to-noise ratio low in finance? Well, because of competition, because of arbitrage. Otherwise, everybody would be able to extract profits from the market. So because of that, when we deploy black box solutions in finance, these solutions can identify patterns that are not real, that they are just patterns in the noise, and confound these patterns with these noisy patterns with actual signal, leading to investment strategies that will fail. So one solution would be for investors to understand very carefully when a product is based on a black box solution as opposed to a transparent machine learning solution.
Thank you. I yield back. I would welcome any of your comments. If you've got follow-up in writing, please share. Thank you.
And as I mentioned, we're likely to have another round for members that are interested here. The gentleman from Missouri, Mr. Cleaver, who's also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is recognized for 5 minutes.
Thank you, Mr. Chairman, and I really appreciate you calling this hearing, and we appreciate all of you giving us your time. I don't know how we're going to deal with AI and human beings. Long before we had flip phones, Captain Kirk had one, and long before we had the smartwatches, Mr. Spock had one, and a lot of attention is always paid to Hollywood, particularly in science fiction, and the military, our own military. And so a lot of people have their eyes on a fearful future as it relates to AI. And to be straight, I'm one of those. I'm conflicted. I know we can't hold back the wind, and it's inevitable that we're going to see more and more of this in the future. And I'm not sure that we ought to try to hold it back, but to the degree that we can control it, that's what I think we ought to do. And that's where I'm concentrating most of my interest. Dr. McElwain, first of all, thank you for being here. But I'm wondering how inclusive this new technology is right now, and what can we do to make sure that in the future that every component of our great mosaic in the United States is a part of it?
Thank you for that question. I share a little bit of your fear because what we know persists as technology changes, as technological advances are made, is that some people, and typically the same groups of people, are left out, left behind, are disadvantaged. And so even as technology is unpredictable, some of those exclusions are very much predictable. And I think those exclusions are present in our current market, as most of the folks on this panel have at least alluded and nodded to. That is, when we look at our technology sector, those who are prepared to be part of that sector, those who are currently working, building the technology as of today and tomorrow, are tremendously unrepresentative of our full democracy, of all the citizens of our country. And I think representation makes a tremendous difference. I think the place we're in today with respect to some of the inequalities and devastations that technologies, AI and automation included, have wreaked has been because not everyone has been included in the decision-making about what technologies will be built, why, for what purposes, who they will advantage and disadvantage. And so I think moving forward, we have to change that. That is, we have to invest strategically in building a more inclusive workforce in these sectors that are growing. That is, the technology sector, in the financial sector as well.
What do you think we should do, or any of you do right now, if we have to have young people interested in and committed to the future, and AI is an inevitable part of it. What should they do next week? I mean, what should young people be doing? How should we direct young people right now who are, scientifically gifted? What should we do?
I mean, I think we need to promote responsible innovation. I know our members support trying to get out there to the middle school students geographically across the country, a diverse population of people, get them interested in STEM fields. I think there is a lot of opportunity for companies to partner with some of the public schools in a geographically diverse part of the country and help fund that. And just recruit now. You know, kids get interested in these fields from a young age. We just got to get in there early and make sure that people see role models at the firms that we promote those public-private partnerships.
Well, my time is up. Thank you very much. Thank you, Mr. Chairman.
Thank you. And now I guess we have time for a brief second round of questions here. You know, we've had sort of two different narratives that have been going on here. One is the sort of optimistic narrative of the, well, I guess the T-shaped skills or machine intelligence, human intelligence pairing. Well, there will be, it's like an augmented human intelligence. And then we also had the mention sort of intermediate way of transfer learning where, you know, you'd actually use one field of expertise and transfer what was learned there to another field, thereby, you know, replacing multiple human machine pairings. One example of that was in the example from the geniuses at Goldman who are using satellite data to analyze cement to predict cement quarry, analyzing satellite imagery of quarrying activities to predict cement pricing and so on in the future. And then potentially using transfer learning so that knowledge could be transferred to, you know, copper mining or whatever else it was. On the other hand, there's an alternative narrative is that you just aggregate all the data you can and just say, I want a general purpose learning trading algorithm to look at all satellite data and look for all market correlations. And that would detect not only the cement market, it would, you know, look at the parking lots of Toys R Us to predict that Toys R Us was going bankrupt because they didn't have many cars on Black Friday. And so this sort of thing could be written once and deployed to replace tens of thousands of even machine-human pairings on here. And obviously with much, much smaller labor input and need for humans. So which of these two narratives are going to end up winning, and how's it going to net out for human participation in this? Anyone who wants to, you know, tackle that tar baby?
I can start and just say that, you know, one of the foundational concepts in investing is that correlation is not necessarily causation, right? And so we have a lot of data and we can see these patterns, but you need a human to ask, what's the right question, right? I mentioned also the example of going through the news stories with Bloomberg. And they said, you know, the key question there was to go through these news articles and not say, what do we think the author of this article wanted to get across, but what do we think people are hearing? So there are a lot of nuances, really, about how this is going to play out. And that's why, again, having sort of the collective intelligence and diverse perspectives is going to be important.
Mm-hmm. Yeah. Dr. Lopez-Soprano, do you have a?
Yeah, I think that the two narratives have some part of truth. I think in the short term, we have reasons to be worried in terms of the transfer of knowledge and the potential displacement that will occur as these technologies are more broadly deployed. But I think in the long term, we have reasons to be optimistic because the next generation will be better prepared than our generation, previous generations. It is very important that we give access to education, equal access to education. It's very important that we encourage kids to learn how to program, that participate in math and engineering classes, and that we form a flexible workforce, a workforce that in the future, we don't know what these technologies will do in 20 years, that they are able to be, to engage productively.
But is there a danger that this is going to suck all the profitability out of financial services? That if you had complete knowledge of everything and very efficient algorithms immediately trading on that knowledge, you know, the 30% improvement in your retirement savings, all of that money used to end up in the pockets of people with nice homes on Oyster Bay. And it's, you know, that's sort of the nature of things. And it may be that when we get this much more efficient economy with extensive deployment of AI, just the total amount of money left to be extracted will continue to go down the same way high-frequency trading is sort of suffering that decline in margins.
Well, one view, if I may, one view is that, in fact, having such perfect market is not necessarily bad for society, meaning that the day that we go to our financial advisor and we receive the same treatment that we receive when we go to the doctor, Essentially, there is a protocol of this is what you need to invest in order to achieve your retirement goals. I think that's a good outcome.
And as we see greater efficiencies, robo-advisors and other more efficient, I'd say, asset managers will be able to deploy that efficiency to the masses. But I think it also raises a global competition question, because we're not just talking about competition domestically, we're talking about internationally, and we're not going to stop time all across the world, right? Other countries are innovating in AI. So, it's inevitable we're going to be competing in that space, and we want to keep the U.S. markets, the envy of the world, I think.
So if the future of financial advising is conversations with Alexa, I guess it comes down to, is the objective that a function that the AI running Alexa is maximizing, is that Amazon's profit? Or is it some linear combination of Amazon's profit and diversity, inclusion, a secure retirement rather than steering people into products that are profitable for Amazon?
I mean, I think the vital part here is that, as you mentioned, we have competition, that there's not too much aggregation of power in one entity. We need to have policies that promote robust competition amongst, let's say, the robo-advisors, that make sure there's data is accessible at competitive prices, so there's not a barrier to entry, right? I mean, this is going to be, I think, an exciting space where Financial Services Committee meets Judiciary Committee on antitrust issues, meets Commerce Committee. Finance is becoming more technology, and technology is becoming more finance. So these are the right questions.
Thank you, and I'll now yield 5 minutes to the ranking member.
Thank you, Mr. Chairman. Ms. Ratio, I'd like to go back and kind of continue our conversation that we were talking about cybersecurity and using AI and fraud, and I wasn't very well managing my time before. So could you explain further how NASDAQ is actually using AI in fraud detection?
Yes. So, I mean, I think it's important just to start that, I mean, the future is here, right? We have billions of data points. It's a massive amount of data that needs to be analyzed to capture anything that is then fraudulent or manipulative in the market. So we have that environment already. And what we have been doing so far is deploying algorithmic coding to sort of be able to process all of this data very fast. I mean, our real-time surveillance is picking up on unusual behavior within seconds after it has happened in the market. So there is really a fast and efficient way to go through the data. But as it is growing and exponentially growing, there's the need, of course, to continue to invest in other ways of looking at it, where AI then comes in. It's more an broader approach, and it doesn't have to be so parameter specific that we are today, so we can capture more things that is more sophisticated, because as we have been talking about, it's not only us using this technique, or the participants in the market are using it as well. So I think it's important for us to match their technology with our technology when we look at the types in the market or the behavior.
Thank you. Dr. Lopez Del Prado, can you touch on the differences between automated trading, algorithmic trading, high frequency, and computer trading, how they're not all the same, and what differentiates each of those?
Yes, algorithmic trading consists in following some rules. A computer follows some rules in order to achieve a particular outcome. It does not require machine learning. Machine learning is the learning of patterns from a set of data with us directing that learning. Essentially what happens is you give to an algorithm a data set, and the data set identifies a pattern we were not aware of. So that's machine learning. What was the, I'm sorry, the third one, high-frequency trading?
The automated trading and high frequency as well.
Well, high-frequency trading is algorithmic trading at a fast speed. It can happen with or without machine learning. So in the early stages, 2005, high-frequency trading occurred without intelligence. But today, what we see is many liquidity providers, market makers, hedge funds deploy high-frequency solutions with machine learning embedded.
Okay. Thank you. Ms. Wegner, we've had some discussion on the cost savings that have resulted from AI and automation in the capital markets. Do you see that these efficiencies are a significant reason behind the record returns investors have enjoyed in the last decade?
I mean, this has definitely contributed to the returns. Every reduced incremental cost of trading adds up with compounding interest over time. So as the markets become more efficient, investors are going to have more in their pocketbooks, whether they're, like half of Americans invested in a 529 plan or otherwise. It's been a net positive.
Okay, thank you. I have no further questions, Mr. Chair. I yield back.
Thank you. And the gentleman from Missouri is now recognized for 5 minutes.
Thank you, Mr. Chairman. I'm interested in, how do we do planning now for the future? For example, we just updated our anti-money laundering bill, or the Bank Secrecy Act. And I'm sitting here now, and I introduced the bill, I've been feeling pretty good about myself until you guys came up today, and I'm thinking, why did we go through all of that? Because the bad guys are out, trying to figure out how they can, exploit whatever we pass legislatively. How do you see AI involved in anti-money laundering efforts, like the legislation that we hope the Senate will take up during our lifetime? Is there any way you think that can play a role, that AI can play a role in our money laundering bills, how we're trying to reduce it? We're never going to probably eliminate it.
Yeah. Well, this is a gargantuan problem, right? We have to tackle tremendous amounts of data, petabytes of data, and identify this needle in the haystack. I think a practical solution is for regulators to work together with data scientists, with the entire community, and crowdsource these problems. We need to anonymize this data and give this data to the community so that the community help us enforce the law. Of course, they can be rewarded with part of the fines levied against wrongdoers, but I think that's a very doable approach, given, number one, how difficult it would be for the agencies to develop the kind of techniques that the wrongdoers are developing for bad purposes, and number two, the amounts of data that we need to parse through.
Mm-hmm. We had the Treasury Secretary before our committee yesterday, and of course, I didn't even raise this issue. We have an agency, FinCEN, which is it's an investigatory part of the Department of Treasury, and so I'm here wondering what they're doing. Excuse me, trying to keep up with the technology and what challenges they're going to face in the future. And so, you guys have destroyed almost every thing I was proud of, but we appreciate you coming here anyway. Thank you very kindly. I yield back, Mr. Chair.
Thank you, and I'd like to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days with which to submit written questions for the witnesses to the chair, who will forward them to the witnesses for their response. I would like to ask our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days with which to submit extraneous materials to the chair for inclusion in the record. And this hearing is now adjourned.
And very solid. And those things that have to do with manufacturing have not been that great. And even in this strong jobs number, you saw only enough strength in manufacturing that it probably came entirely from the GM strike ending and them coming back. I think the strongest story of the U.S. economy was, is, and remains that the U.S. consumer remains confident and keeps spending.
Austin, I'm curious, that wage increase, 3.1%,